Hey guys, this is a trade on a calendar. I want to show you how a calendar works. You may or may not want to put this trade, but I want to show you how it works. What we're looking at is the SPX, the index itself. And right now it's at 1552. You can see the live line here. That's at 1552. And we have, let's go look at the options. And what we have is something that expires in one day, which is tomorrow night, after close of business Thursday, but the print will be of the Friday morning because these are the monthly options. And we also have weekly series that expire in 9 days and in 15 days. So you can pick either one. The philosophy of the calendar is that the front option is going to decay much faster. And that's obviously, that's pretty clear. So we're going to have a theta decay of $1.45 today, and then tomorrow it'll be obviously a much larger number. So you're going to see a theta decay, of a very heavy theta decay in the front month. So by buying the back month or any of these weeklies for that matter, what we are going to capitalize on is the rapid decay happening in these options, the one that's expiring after close of business tomorrow. And then what I have here is I'm buying the March 5. So that is this one right here, which has 15 days to expiry. Now you could buy the March 4, which has only 9 days to expiry. But if you choose March 4, there's going to be higher time decay on the March 4, obviously, because it has only 9 days as opposed to 15 days. And secondly, but the benefit you get is going to be from the margin. So if I were, on this particular trade for 10 contracts, we have a margin of 7,500. If I were to choose the March, and also note this theta figure for $947, if I were to choose the March 4th, then you can see that the margin comes down to 5,000 and so on. But your theta decay is also less because the March 4 series obviously has only 9 days to expiry. So those are the two things you have to match up. And most importantly, what you have to match up is the risk profile. So if you look at the risk profile, the March 4 series is a little too close on the downside. So it's about 1544. On the upside, we are okay. It's 1565. That's because the SPX is trading 2.5 points above our strike price. So you're going to see this have a slightly bullish bias, and we have more room on the upside than the downside. Now, that's fine. I do want to keep it that way because the sentiment generally has been positive. So I'd like to give more room on the upside rather than the downside. But what we want to do is also look at the March 5 and see what that looks like. So now you can see that on the downside, we are still at 1544. And on the upside, we are at 1566. So it didn't do too much over there. But what it does is it gives you, it obviously you require a little bit more margin. It gives you a higher theta decay. And so those are the kinds of things that you have to balance out in a calendar. So if you ask me, I would prefer this one, even though it's a little bit more of a margin. And because, see, the margin doesn't matter because when you close out a calendar, you're going to close out the entire trade. So both the long and short, you're going to close it out. What you're really capitalizing on is the time decay between today and tomorrow. And hopefully this white line is going to stick into this little triangular area here. And you can see, let's move up the date. And you can see, boom, one day it goes up right there. And then tomorrow, after close of business, it's going to be max profit. So, that's what we are capitalizing on. So, and even if we wanted to close it, you wouldn't just close the shorts. You would close both of these together. So that's the calendar trade. I'm going to put it on. If you don't want to put it on, that's fine. But this is more for educational purposes so that you understand how a calendar works. You're going to be theta positive and you're going to be vega positive. So if you remember, a calendar is one of the few trades where you have theta positive and vega positive. So this is a very important characteristic. If volatility goes up, we are going to gain. Usually in any strategy, theta and vega are always in conflict. So either you're going to be theta positive and vega negative, or theta negative and vega positive. The calendar and the diagonal are the only two trades where you're going to be theta positive and vega positive. So we know now the VIX is at its lowest. So, we want to be vega positive. So if volatility increases, this would increase our profit. So it's a good time for a calendar. And what we want to do is put it just for 2 days and see how this goes. So I'm going to, open up this trade as soon as the market opens. I may not get, this price. I may have to pay a little bit more. It's a debit trade, remember, because your long option is going to cost you more than the short option. So you're going to sell the short, the short in the immediate, which expires tomorrow, and then you're going to buy this March 5, which has 15 days. So obviously you're going to pay more for that, and that's why it's a debit trade. That's your max loss though. And your profit, you can see, if it expires exactly at 15.55, then you have a max profit of about 4,000. So, that's a pretty good risk to reward, $4,000 profit. But of course, it has to expire exactly there. But that doesn't matter. You have a profit zone of this much right here, of about 20 points between 1544 and 1564, or even more, 22 points. So that's your profit zone. And that's where we would like to see the SPX expire tomorrow after close. But we may not hold it for after close, because remember, the SPX monthly options, their opening print on Friday morning is what determines their, the option prices. So you don't want to take that risk overnight. So tomorrow, if this trade is going well, if this thing is going right into our profit zone, we may have a profit of about $2,000, $3,000, and we would want to close the trade out at that point. So that's the calendar trade. I'll keep you updated on this.